Good afternoon, everyone, and thank you for joining us. I'm Luke Ellis, and I'll be hosting today's session alongside my colleagues Mirko, Anthony, Patrick, and Lisa as we unpack what is shaping up to be one of the more significant federal budgets we've seen in quite some time. However, before we proceed any further, I need to provide you with the obligatory disclaimer. Today's webinar is general in nature and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances before acting on it. Now, also by way of housekeeping, the chat feature will be open throughout today's session. Please feel free to raise any questions and we'll do our best to respond to these. And if we don't, we'll be sure to come back to you as soon as possible thereafter. Now, Jim Chalmers promised that this would be his most ambitious budget. And as it turns out, ambitious in Canberra generally translates to we've found more things to tax. But if we actually put the jokes aside, there's actually a coherent theme running throughout this budget. And the government is clearly trying to shift the system away from rewarding accumulated wealth towards younger workers, housing supply, and what they're calling intergenerational fairness. Now, if we're honest, there's parts of this where it's hard to argue with. We know that housing affordability is cooked. We know that productivity is weak. We know the debt is climbing. And we know that Australia absolutely has a system that favours people who already own assets. So that we know, and that's the policy logic. The issue, as always, is the execution feels just a touch too convenient. And let's just say that our trust in politicians is not sitting at an all-time high at this particular moment. Now, all these reforms also happen to raise a healthy amount of revenue. And it's exactly at a time when the government needs it most, which, is always funny, I guess, from that point of view. Now, I guess you can't help feel that this is step one and step two will be as we approach the election. So what we saw last night was the government turn around and say, okay, we're going to take some money off the table, collect more revenues from that point of view, but they haven't given too much back. However, there is an election, I think, just on about 18 months' time. So more than likely, there might be some sugar coming your way. Not just yet, maybe next year. Now, clearly, that's the government playing politics, which is always entertaining. Now, what's important is that today isn't about panicking or knee-jerk reactions. Most of the changes that we're going to talk about today are still some time away, and they're actually going to evolve before they become law. What today is about really is just understanding the direction that we're heading in and understanding the potential impact and making sure that you are positioned as best as you can be moving forwards. So without further ado, let's dive into the detail. Anthony, you are you're our tax manager, tax partner here at Innate, and much loved, I must say, from that point of view. And the big change is on the capital gains piece. So let's start with that one. Now, for those at home, last night the changes in capital gains were pretty enormous. So I guess in talking that through, Anthony, what are those changes and what is the government proposing?
Thanks, Luke. And it is big reform, but we knew something was coming. They've been talking about this for several weeks. What we didn't know was what the nature of what sat underneath and how it was all going to play out. So for capital gains tax, from 1st of July, the government will revert to an indexation system based on CPI. Now, for those old enough to know, that's the same system that operated between 1985 and 1999. So that will take effect from 1st of July 2027. Now, the intention is with capital gains is that a minimum tax rate will apply on any gains made post that date at a minimum of 30%. Now, there's only a few exceptions to that. Now, the other thing which we didn't see coming, or I didn't anyway, was pre-CGT assets. So these are assets that were acquired pre-20th of September 1985 when capital gains tax reform was first introduced. The exemption on those assets that currently exist will be removed post 1st of July 2027. Now, all asset classes are impacted. They haven't distinguished between property or shares or any other things, whether that's shares in a business, etc. And it applies to individuals, trusts and partnerships, not companies or super funds. Now, the only exclusion at present is effectively what they call new residential builds, and we'll talk about that a bit more later, but they can still adopt the current 50% or indexation as a preferred method of calculation.
Okay. So I guess from that point of view, with what you've just explained, there's a fair degree of grandfathering that we can see. And so just to get this right in my own head, existing assets, so people who own those existing assets today, these won't be taxed retrospectively. Is that what you're saying?
Yeah, that's right. So there's transitional rules for existing investments. So at the moment, we operate under a CGT having a 50% discount for those structures that I mentioned earlier,
Yep.
and pre-CGT assets are exempt. Now, it's effectively they will be grandfathered up until 1st of July 2027. So through to that point in time, the same rules apply. What that means is that if there's a sale of an asset post 1st of July 2027, you'll actually have two CGT components or two calculations assessed under the pre-rules, so as in pre that date and post.
Okay.
So under post rules, whereby an asset spans both periods, there's potentially two methods to determining the values. One is effectively evaluation, which is a little grey at the moment as to what the requirements of that are. Or two, it's a pro rata of the gain based on the time pre and post that 1st of July 2027 date.
Okay.
Any gains then post 1st July 2027, indexation has to apply. But anything pre that date, the existing rules apply. Quite complex.
Yeah, it does sound it. I guess from that point of view. Now, if we were to step back from politics for a moment, do you actually think there's some merit in what the government's trying to achieve here, or the execution sounds quite complex. So, but in terms of what they're trying to achieve and the rationale behind what they're trying to do, does it pass the sniff test?
Yeah, I said all along, and we've been arguing this in house for a while, is that grandfathering would have to be considered for the existing assets, and thankfully that has been adopted. Yeah. What we didn't see coming was how pre-CGT assets would be impacted. Now, as time goes by, those become less and less, of course. But what they're doing is effectively, in my view, putting a line in the sand at 1st of July 2027, and all future gains then apply indexation with a minimum of 30%, except for the new builds. So you're right, it's going to be complex. There's plenty of work for the accountants amongst us, but I think it is a step in the right direction, although the collection mechanism from this process will be slow and over a long period of time.
Yeah. It also, I think it's also ramped up the importance of accountants moving forward, I dare say, Anthony. So you'd be smiling like a Cheshire cat.
They will never be able to work whilst the government's in play.
No, fair point too, mate. Fair point too. All right. Well, look, that's the capital gain side of things. The other big change was in relation to negative gearing, and we do have an aspiring tax expert in our office, being Mirko, who loves to delve into these sorts of things. Mirko, negative gearing has been radioactive for a number of years. Bill Shorten tried this and blew himself up, if we remember, back in 2019, and here we are all over again. At a high level, what's the government proposing, mate?
Well, look, this is a controversial one, and always has been every time it's been flagged. But they're actually pushing forward with it. And that negative gearing, just for in absolute simplicity, is people borrowing money to invest and then using the losses on that investment to offset income, across their entire structures. So, being able to offset income against salary and things like that. So it can be quite attractive and certainly has proven to be so. What the government's looking at doing is basically removing negative gearing for new purchases of established properties. So, the home that's already in place, and you're looking at sort of buying and negative gearing, they're getting rid of all of that, and basically the real target here is that what they're trying to do is sort of say, we will allow you to negative gear, but we want to do so in the sense of new builds moving forward. So the idea, the theory here is that if we can encourage new supply, it may go somewhat towards that 75,000 homes that we need built with the undersupply. May give opportunity for young people that are struggling to get into the property market today to actually be able to sort of do that and afford to be able to do that. So quite an interesting change there for all those people that have fallen on the floor because they're part of those million people that hold negative geared properties. There is no change to existing properties that are being held, and if you had them pre-budget night and the like, it's all good. There's going to be no changes in the way things sort of go forward for you. It really is from last night moving forward. If you do buy a property between now and the 1st of July next year, you actually can negative gear it in that sense, but that will then stop. So significant change on that front for all, and and then sort of questions beg, is the intended purpose going to work? Directing it towards new supply. Does this create unintended consequences? And what does it do for the established market as well?
Yeah, that's an interesting question that you asked there. I guess because you've got the established market and you've got the new build market, and we don't have enough tradespeople either, Mirko. So trying to manage these three things, and and I guess the other question there too, and just for my own mind's sake as well, this from a we're talking about increasing supply. Is that right?
Yeah, that's the idea. So, allow people to negative gear into new homes, and hopefully encourages more building and the like, more house land packages, more developments of existing sites, and things like that. Into multi developments. That the idea is that we're encouraging the growth of that sector. And
Yep.
the end game is hopefully allows people that feel like they're not able to get into the market to be able to get into the market.
Okay. So just to clarify, so if I was in my own house, I wanted to knock down my existing house and build a new house, that wouldn't be negative gearing. But if I was to knock down my house and build a dual lock or two houses, then all of a sudden that would be negative gearing because I'm increasing the supply. Is that right?
Yeah, correct. That's how they've sort of defined what a new dwelling is and the like. So, yeah, you sort of expect to see a lot of off the plan action and things like that occur. I just thought of something as I was saying that. What does that do to the stamp duty take of say state governments if all of a sudden there's a whole heap of off the plan stuff going on? I dare say that's going to hurt.
I was going to say it would too, because the stamp duty on a block of land is often lower than it is on a new house. That's for sure, from that perspective. So that's an interesting one. Do you think, Mirko, like given the practical impact, do you actually think that we're going to see a change in investor behaviour as a result of this? Is it something which is going to be where investors go, I'm done with property, I'm going to go do something else? Do you think there might be another beneficiary in all this?
Yeah, look, potentially, and just sort of thinking through what the opportunity set is, and there's been no talk about negative gearing getting wiped out for other asset classes apart from existing dwellings. So all of a sudden, if a person has the equity, has the capacity to borrow, does margin lending into investments, equities, managed funds, etc., does that become in favour all of a sudden as well? Does doing things through superannuation become opportunistic? So I think that some of the unintended consequences, if you like, will be money may be redirected elsewhere.
Yeah, no, absolutely. Look, thanks for that, Anthony. I'm going to head back to you because the next one was family trust, and this one was a doozy in terms of what it's trying to do. And I guess family trusts have been around forever, and Treasury has now effectively said, yes, we've noticed. So up until now, we had this little fugazi that we could kind of hide things into family trust, but Treasury has gone, no, we're paying attention here. What are the actual changes on the family trust side?
Yeah, well, look, trusts have been around for a number of years, and this reform has been spoken about probably for as long as I've been in the industry, and I've probably got more grey hair than everyone on the screen. The proposal is that trust income will incur a minimum 30% tax arising from discretionary trusts, or what we know as family trusts, from 1 July 2028. So what that means is that the tax will be imposed on the trustee. Trustee pays a 30% tax. That then flows through to the beneficiary with a non-refundable credit. So why? For a long time now, what families have been taking advantage of is the ability to distribute income from family trusts. Now, whether that be passive income or whether that be business income, to lower income beneficiaries. The clear aim, and it's been spoken about for a long time, is to stop this. Yep. Discretion of income will still exist. You'll still have the ability to distribute to beneficiaries, but with a minimum of 30% tax. So this aligns to the CGT minimum tax that we spoke about earlier. It also aligns to companies that are passive in nature, that are not carrying on business. They also have a 30% company tax rate. So it's effectively trying to align all passive income. It's been a long-standing planning tool for many families for years, and governments have talked about reform in this space, as I said, for a long time. This one has had the courage to tackle it. Well, they're trying to stamp out. Yeah.
Sorry, mate, just from that point of view, does that mean that the usefulness of trust now is off the table?
Yes and no. You've still got the benefit of top marginal tax rate is 47%. So some beneficiaries you've still got that scope between 30 and 47. You're just not going to have the ability to distribute to effectively what we classify as low-income adult beneficiaries, which we see a lot of. But trusts still provide a legacy tool for families, and it also still provides some asset protection. So I think there'll be considerations as to whether they're removed or shut down or made dormant in favour of other simpler structures. But I think that's a review on a case-by-case for each family.
Okay, fair enough. And I guess from that point of view, just thinking about what you've just explained, small businesses, mums and dads who run small businesses, for example, who've structured their affairs through such a trust, and they may have been distributing the kids or distributing monies to kids who are above 18, going to tertiary or whatever. From that point of view, they're the ones who are going to be impacted the most by this, I dare say.
Yeah, you got to feel sorry for the ones that have set up business and they've been waiting for their kids to get to 18 for years and years and years, hanging out for this tax benefit, and now it's going to disappear right in front of their eyes. So it just means that you just need to do a complete review of the family structure, now whether that's companies, trusts, superannuation, and everything else, as to the relevance of that trust, given the minimum 30% tax rate.
Okay, and just so we're clear on that one, so if a child who's 21, for example, receives a distribution from that end, and the trust has already paid the tax for him at 30%, but that child only would pay tax at 15%, that difference normally that's lost now. Yeah, they don't get that back.
Correct.
Wow, that's a massive change. That is a big change. Okay, all right, that one hurts. That one hurts. All right. We're now going to talk about the small tax cuts for workers. And I'm going to go to you, Pat, because I noticed you've been sitting there chomping at a bit and wanting to make a contribution here from that end. Well, now, the government is, look, in theory, you can see they're taking money out of the capital gains, they're taking money out of trusts, they're taking money out of this, so it's take. Give us something, buddy. Is there any good news on the front of people getting money back?
Finally, we have a winner, and we have a new acronym as well. So we've brought in the WATO, or Workers Australian Tax Offset. So this is basically giving some money to people that are feeling the cost of pressure of living and all these kind of things. So now it's going to be a new permanent tax offset for workers. So it's not going to be on all your income. You've got to be a worker, and it's basically $250 per financial year. So that's also coincides with obviously the marginal tax rates and the low income tax offset, LITO. So I did some quick sums. So for this financial year, effectively everyone always goes, yeah, you can earn $18,200 tax free. But when you factor in LITO, or the low income tax offset, that actually jumps up to $22,575. Yep. Next year, it'll be $22,866. And then when you factor in LITO, WATO, and the tax-free threshold, that's actually going to be $24,985 of tax-free monies you can get.
All right, so just to get this right, you've actually got to be working, is that right?
To get WATO, correct.
Yeah, WATO, okay.
Yes.
Okay.
And then they've also introduced instant tax write-off as well.
Yep.
So traditionally, when people are doing their tax return, if they didn't have many deductions, Most people would chuck $300 in there because you wouldn't have to have receipts for the $300. So everyone would always just do $300 of laundry. Now they're bringing $1,000. So basically, you can do $1,000 without any receipts, and then still claim other deductions on top of that with receipts.
So no more shoebox.
No more shoebox.
Hey.
And everyone just bumps it up to $1,000 deduction, which is great. So that's going to help a lot of people, especially on those that lower threshold where we just talked about LITO, WATO, now another instant $1,000 write-off straight away when they're doing their tax return.
No, awesome. Now, Pat, just to get this right in my own head here, you said 250, is that right?
Correct.
All right. Now, so the last time I looked, what's the cost of a cafe latte, mate?
Well, it depends if you want soy, caramel. It depends what you want. But you're thinking, yeah, exactly.
No,
it's not gonna increase people's lives at all.
Yeah, I didn't think so, mate. Look, and look, $250. Don't get me wrong. If you go to the supermarket, it might pay for half a trolley, perhaps, depending on your circumstances. They might pay for that. So I get it. There is some cost of living relief, but when you kind of sit back and you go $250 spread over the course of 12 months. That isn't a coffee a week, for God's sake.
No, and especially when you've brought in these huge tax reforms, it's like you've taken a lot and dangled a little bit on the end. So, yeah.
Okay. You know how in my opening gambit there, I kind of said that, they're taking a lot and you just feel like we're being positioned for the sugar hit in 18 months' time with the election coming on. Do you reckon there's a bit of truth in that?
Possibly, yeah. Yeah, and this is where they're saying we're focusing on the cost of living pressures, and this is one way they've sort of said they're doing it, but it's very minute.
Yeah. Look, I guess the other argument there too is we are in an inflation, problem. We've got a massive problem in that regard, and I think based on the numbers last night, they were forecasting inflation to peak at 5%. So with that being the case, to then go and throw more money into the system. Yeah. Is somewhat counterproductive because obviously the Reserve Bank is saying, well, hang on a sec, you need to do something because we can't just keep on raising interest rates.
And this doesn't come into, it's applicable 1 July 2027, so this won't flow through for a long time.
Okay. All right. So, so this is all kind of nice. All right. Well, look, thank you for that, man. I appreciate that. And I'm really pleased at the fact that I'm going to get a coffee a week, which is going to be proudly sponsored by the government. So thank you. Lisa, we're going to come across to you, Lisa. On further good news, there'll be some changes on the aged care and home care front from that point of view, and which is good. And I think the government is recognising that there's a problem here, and they've got to do something in that space. Do you want to talk us through some of those key measures?
Sure. Well, last night's budget allocation, which was $3.7 billion for aged care, really was largely previewed already. On the 22nd of April, Minister Mark Butler presented at the National Press Club, and so we got some media coverage at that time. So some of these changes might sound very familiar already. $1 billion of that was announced to cover the cost of moving some essential personal care costs like showering, dressing of wounds, and what's called non-clinical continence management. From 1st of October, they'll be moved from the independence category to clinical support. Fundamentally, what that means is people will no longer potentially have to make a co-contribution towards getting help with those things. And that's can be quite expensive at the moment. Some people have to pay 50% towards those hourly rates, and those hourly rates are often over $100 an hour. So this will be a very important change, and hence it's going to be a little bit costly, $1 billion there. They're also going to bring forward some of the placements that we were going to see with support at home. So additional packages, they're going to be brought forward because we do have quite a problem with waiting lists. $200 million was announced as part of that $3.7 billion to help with 20 new specialist dementia units. and expanding a hospital to aged care dementia specific program that only started in 2025. That program has already helped 700 people leave hospital and move into dementia specific care. So really great outcome for those people, but certainly need more funding in that area. And then the remaining part of that 3.7 billion is going to a variety of things like constructing 5,000 more aged care beds over 4 years, upgrading buildings, enforcement of the sector, some computer system upgrades, and a range of other smaller elements.
Okay. Well, look, and unfortunately, this seems like an endless bucket with aged care in terms of how much can you keep on throwing into it. But I guess from a practical perspective, are these changes directionally positive for older Australians? Like trying to navigate this system, are these a good thing, do you think?
Oh, look, these are important spending areas. They are positive, but as you say, it's arguably a drop in the ocean. In 2025, we had estimated 176,000 people living with dementia in Australia, and over the next 20 years, that's going to go up to 422,000. So 20 new residential units is a drop in the ocean to deal with that. So we certainly are going to need a lot more spending in this area. And then the question is, how to pay for it. And fundamentally at the moment, there are 200,000 people waiting for either aged care beds or packages to be able to commence. And wait times are currently 10 to 11 months. And the target was to get down to 3 months. So hence this bringing forward of some of these packages to try and have some of these people on waiting lists get onto their packages sooner. So look, really substantial problems in this sector. And the third one, I think really important to mention is bed wait times does reflect a particular change that happened back in November, which is really starting to, see the unintended consequence of that now. And that was the removal of targets for what we call low means people in the past. They're now called supported people. These are people who don't have a lot of financial means. And so there used to be a certain number of beds always kept aside for those people. That was scrapped. And so what we're starting to find is for some facilities, they're really picking and choosing and really looking for people who have the capacity to pay those RADs, those bonds by the old language, those big fat lumps up front. And so we're seeing people languishing in beds, often in hospital, or they're at home struggling through and at risk. So this sort of area has also been addressed in the budget to a degree, but fundamentally what we really need to see is going back to a system of requiring the provision of beds for low means residents, because quite frankly, if we look ahead at the demographics and people's finances, we are still going to have a substantial portion of people moving into care that will be qualifying as low means people. So this is an area that has only been partially addressed with the budget and needs much further work. Fundamentally, what they're going to be doing to try and encourage more beds for low means people is providing facilities with an extra small proportion or a payment per day if they are constructing and building more beds specifically for low means people. But that's a nice incentive, financial incentives are good, but fundamentally it's not really going to be a short-term measure to deal with this particular problem. And fundamentally, aged care is always a bit of a tricky one because, we've got for-profit companies, right, operating in an area which is not profitable. It's not profitable to help low means people, right? And so this is always the conflict in this sort of sector. Yeah,
absolutely. Lisa, just from a funding point of view, and just focusing on what this was announced by Mark Butler, I think on the 22nd of April. In order to fund some of these initiatives in terms of aged care, what they were doing was removing the private health rebate or the private health insurance rebate for older Australians.
Yeah.
So previously, older Australians were receiving a rebate and getting a discount or paying lower than what somebody in their early 20s or early 30s would be paying because of the way the rebate worked. One, I was caught by surprise as to how big the rebate was in terms of its value. What's the unintended consequence of that? Do you think a lot of the Australian, like this, in a cost of living crisis, is the risk that a lot of older Australians turn around and go, I can't afford private cover and get off the system?
Well, before people make that assumption and decision, it is a estimate in the actual budget documents was that measure would change your premiums by $84 per $1,000 of premium. And so for the average person over 65, they estimated that would be about a $240 over a year impact. Now, that's unfortunately, they're not workers, most likely, and get the benefit of the tax offset on the other side of the way too. But look, nobody wants to ever pay an extra dollar. I appreciate that. But this was an area that is been costing the budget a lot of money. Jim Chalmers also connected not just the private health insurance change to helping fund the aged care side, but also, of course, NDIS. And it's always a bit of a tricky one when you cut healthcare spending to cover other healthcare spending in an aging population. Fundamentally, of course, we want to cut waste and, we want enforcement and things like NDIS, etc. But we need to potentially find other ways rather than butchering into the healthcare sector itself. Arguably, the gas export tax proposal, other ways to find funds, will be popular with the electorate. And we've seen, some early polls and surveys where people are supporting ideas of that sort of nature.
Yeah, of course. Thank you for that, Lisa. And I'm going to drop back into you quickly, and it's only because it's probably more a focus point with everything that's going on in the Middle East at the moment. We're in the middle of an energy crisis, the cost of fuel, people are going nuts about these sort of things, and there is a move, or there is a consideration of, do I go out and buy an EV? Or an electric vehicle. And whilst we were, previously when you went out and bought an electric vehicle, particularly through a novated lease, there was a fairly decent free kick that went your way. But last night we saw the paring back of that a little bit. You want to give us an update there?
Yeah, so the EV FBT exemption currently in place is going to get wound back from April 2029. So in effect, if you buy EV today, it is effectively FBT exempt completely, and which is providing a considerable free kick to those participating. So the government still wants you to buy EVs, and it's great for the environment, and particularly less strain on fuel in situations like we've got at the moment. But effectively, that's going to get scaled back to a 25% discount over time.
Okay. So I think the rationale that the government used on that basis, they were talking about EVs, and when they first brought out this policy, there weren't many choices, and the going rate was, in theory, they were looking at the Tesla in theory, which was the baseline. Today, we have a lot more EVs where they're coming in at 30 and 40 grand, 50 grand. So from that point of view, would it be fair to say what the government is doing kind of makes sense?
100%. I think there was a complete underestimation in terms of the take-up of people probably wanting to buy electric vehicles. Mm-hmm. And on top of that, the volume of suppliers that have actually entered the Aussie market. As you drive down the freeway today, look around you, probably 50% of the cars are brands that were not here 2 years ago.
Yeah, of course. Yeah. The other thing that's also interesting is that the government, when they did their research and so on, they were looking and going, well, it was the affluent people who had the EVs rather than your battlers from that point of view. So they were the ones picking up the benefit. So as you can see, this budget has really targeted the people that were picking up benefits, i.e. people with trust, people with capital gains, people with negative gearing, and now the EVs from that point of view. So that's the emerging theme. If you were trying to figure out what that looked like, that's that one. Guys, thank you for doing all that kind of stuff. One of the concepts around the budget last night was this whole concept of productivity, and Kim Chalmers was very quick to hone in on that. And what I'd like to do is open up to all of you, from my perspective, because I think if we think about business and productivity, it just feels like there's a bigger issue that's sitting underneath this budget. And if we look at what Jim Chalmers introduced last night, there were actually some sensible business initiatives announced last night. And those initiatives included, the instant asset write-off up to 20 grand. So in theory, a small business today up to a turnover of $10 million. Is that right, Anthony?
Yes,
that's right.
Yep.
So they could write off up to $20,000 with one asset, which is cool. So they don't have to go through the depreciation, which is efficient. The government came up with some incredible estimate of saving 3,600 hours per year. I don't know where on earth they got that one from, but apparently that was going to do that. There was also an innovation support, and there was a better loss carry-back provision as well. So if you're incurring capital or income losses and all that kind of stuff, you can bring them forward and offset against, if you're incurring profit losses and you had previous gains the year before, you could actually claim some of that back, these are all good things. I guess the question, when we look at what the government did, they've had all these meetings around productivity. They've spoken about the importance about why we need to become more productive. But yet, when you look at the budget papers, our productivity today is languishing at 1.75%. And if you look at the papers themselves, it's actually not forecast to rise. So I guess, Pat, if I can go to you, mate, just if we look at what the government's trying to do and all this focus on productivity that they're talking about, do you think this budget's going to help productivity, or is this budget more about distributing the pie?
Probably the latter. We're just, distributing it around, because you said those things. They brought in these measures, but we all know those measures will do some, but productivity growth comes from, encouraging investment, rewarding risk-taking, improving efficiency, removing bureaucracy. Like, these are the things that need businesses to grow and produce productivity, So I think it's just more redistributing the pie, if anything, because people are not getting rewarded for taking risks, not getting rewarded for employing people, so they just basically retreat. So and then productivity retreats.
Yeah, look, I'm finding myself agreeing with you a lot on that point, because when I look at what the government was trying to do and the big focus, and when you listen to Jim Chalmers speak a lot, it's about the productivity thing, and you kind of go, well, none of this has done that, and you, by taking money out of whatever you're doing from that point of view, that's distributing. It's not actually adding to the pie stuff. I guess, Lisa, just extending on that, how careful does the government need to be around removing incentives from the system? So when you think about that in the context of what the government's trying to do, and don't get me wrong, there's other things that they're doing which make sense, but when you look at that, does the government need to be careful that it doesn't take out too much incentive?
Certainly, we're not in a strong enough economic position to be removing incentives. And, these are some minor improvements perhaps in certain areas. But for me, the other part of productivity is also preventing waste, right? Waste of time, waste of money. And I don't just mean AI drafting our emails or something, but it's also, the popular one with the electorate, spending on enforcement and supervision in things like aged care and NDIS. Sadly, there's this perception out there that it's magic government money and greedy people, reaching in to charge extra on their hourly rates and these sorts of things. It's almost like it's a pastime in Australia to find ways to, rip off programs and justify it because everyone else is doing it. So I do think there's a bit of a societal step up needed there in terms of wasting money and effectively stealing from taxpayers, stealing from each other. There were also some other, minor opportunities presented in the budget, 86 million for fraud detection for the ATO and the super system. So that's a welcome element, 260 million over the next 4 years to continue to fund the National Anti-Corruption Commission, which looks at federal politics level and bureaucrats, 17.8 million over 4 years for enforcement in the area of managed investment schemes to prevent things like First Guardian and Shield Master. So, they're not exciting areas, but that also helps prevent people losing money and money and time being wasted. And I think just those two words, reducing waste, is a real winner with the electorate.
Couldn't agree with you more on that point. Couldn't agree with you more. Mirko, I guess a question for you, and if we think about what the government's trying to do from that point of view, and and correct me if you disagree, but if people feel that there's little reward by taking risk and building businesses and creating wealth, so extending on what Pat was saying before, do they stop actually trying? And do they actually just turn around and go, what's the point? I've had enough.
Yeah, there's certainly an element of that, and that's one of the big risks that we face. And we've talked about the redistribution of this pie, and but we haven't really spoken about how we're going to grow the pie. And I think that's something that's sort of been lost here. And and for me, the irony is that all these people that have built all this amazing amounts of wealth and everything, they didn't seem to have a problem with productivity. Over the years, the problem is right now. Our productivity over the last shorter period of time has been an absolute disaster. But we don't seem to be sort of solving for that. I am a little bit concerned about removing the incentives to sort of have a crack and actually try and do something, be entrepreneurial and the like, and that you think about. The world that we live in now. It's very global. You look at young people today; they don't have homes because they can't get into homes. We've realised that from where we're at and what a lot of the direction of the budget is at. They don't need to be in Australia, right? So they don't need to start aggressive startups and the like in Australia. They can do that anywhere in the world. And if the incentives are better elsewhere, guess what? That is exactly what's going to happen. We've seen that with our universities. Simple things like all of a sudden we had this issue with we didn't have the income coming in from foreign students in the universities. All of a sudden research gets cut. Well, guess what? I'm going to go and do my research in Boston because Massachusetts is happy to pay for my work. And who benefits from that? It's certainly not Australia in the end. Yeah. You guys know I love a story, and I think it's time for a bit of a story. This reminds me of the Croatian coast, middle of summer, bloke with his fishing rod on the side of the beach. Yeah, and he's fishing away, and a German entrepreneur pulls up in his massive 150-foot yacht, and he gets off the boat. He walks down the pier, and he walks up to the guy fishing. He goes, "What are you doing, mate?" And he's like, "Yeah, it's a bit of fishing, And he said, "Oh yeah, do you catch many fish?" He goes, "I'll catch a couple of fish, for myself and my partner. We usually." Have lunch. And the guy says to him, the German guy goes, "Well, have you considered maybe picking up a boat or something?" And he said, "Well, what for?" And he said, "You can go out a little bit further, maybe catch some more fish, and, you can maybe sell some of the fish to the market." And the guy's thinking about it, and he goes, "Yeah, well, what would I do after that?" He said, "Well, maybe, get a bigger boat, get multiple boats, you can, start fishing, plenty of fish out of the water, maybe go into manufacturing, distribution, employ hundreds of people and, go global, and the guy's sitting there going, "Oh yeah." And he said, "And what would I do after that?" And he said, "Well, then you sell your business and you make a whole heap of money and, you can relax and enjoy yourself." And the guy looks at him, he goes, "Mate, what do you think I'm doing right now?" He goes, "Why would I even go there?" I get the sense that there is a lot of people on the edge of the water with their fishing rods at the moment. And they're sort of going, "Why would I make the effort if you don't give me the incentive?"
Yeah, I love the joke. I reckon I've heard it 1,000 times. My dad's raised it many a times too. And look, I do share some of your concern there, Mirko, in the sense that even on the trust side, the capital gain side, there is no question. If you actually look at the data does point to the fact that the minute the capital gains discount was introduced way back in 2000, property prices went through the roof. And and I think Alan Kohler wrote a brilliant paper. There's a quarterly essay, I think late last year, that we actually spoke on in Pulse from that point of view. If you haven't had a read through it. The data is clear. When capital gains was discounted, you saw the property market go through the roof. So that I kind of accept and go, that's kind of cool. The negative gearing, the fact that we were able to claim it against all the incomes, you kind of go, well, okay, that seemed to be a bit crazy from that end. But the trust one, I do wonder about that, because you just kind of sit there and go, well, okay, most family businesses and most small businesses who are running through trusts, they don't get many free kicks. They're paying tax at marginal rates, they're doing all those sort of things. And the ability to be able to distribute flexibility with some flexibility from that point of view, provided a kicker. And I think Pat and I were talking about this earlier this morning. It's really only for the short term, because the kids are 18 to 21, 22 for a very short period of time, then they're out working anyway. So it's not like this was an endless pool of money from that end. And the problem there is when you go and do this, the poor business owner or the poor entrepreneur or the poor startup is just sitting there going, well, what's the point? And you're right, Mirko, they do look around and they go, well, if there's opportunities in India, if there's opportunities in Portugal, if there's opportunities in Spain, one, we know the climate is just as good as it is here in Australia. Two, we know probably the food's better, without being rude. We know the wine's definitely good. That we know. And if you've got a fetish for a Negroni every once in a while, going to Europe, you can't go wrong. So you've got all these sorts of issues, and you kind of go, these guys are in competition, yeah? So it's one of those things where I think the Australian government just really needs to open up their eyes and go, there's a bigger game at play here, and putting their hands in your pocket continuously does feel a little bit awkward. Guys, I'll go to each one of you, I guess, from that point of view. If we were to give a rating on the budget, good, indifferent, bad, I guess, from that point of view, and a couple of words as to why. Anthony, I might go to you first. What are you thinking, buddy?
I thought last night we knew most of the tax reform that was coming, and probably the need for it. But I think you're right. It's the incentives bit that is quite a detractor, and not. I haven't spoke to a lot of clients in business this morning, but I think that'll be where a lot of the pain and the aggression or frustration will be. So yeah, I would say probably a 5 or a 6. I think it hits where it does on parts, but there's not that upside. And as you said earlier, we're hoping that maybe that's in 12 months' time pre-election.
Yeah, no, fair enough too. What about you, Mick? What are you thinking?
Look, I think if you were judging it on a couple of factors, one being a short-term band-aid solution, it would probably rate pretty highly, right? Because it plugs a big hole for the government right now, and in targeting those areas. But I think if you're looking at long-term structural change, well-being of the country as a whole, I think it's one of those ones that you're hoping your parents don't see when your report card comes out. You go, hope they missed that mark on that particular subject because it didn't go too well. So, yeah, look, I think we've missed the big picture stuff here, right? At the end of the day, it's all good and well to do this redistribution and make it a little bit more equitable and all the rest of it, but we still have to have a situation where we have the massive incentives and we want to be known as the nation of doers and getting stuff done and being innovative and being entrepreneurial and the like. And I don't sense that we've nailed that part of the puzzle.
Yeah, no, fair point too. What about yourself, Lisa?
Look, I felt like it was a bit of a taster to see how the electorate reacts to to changes that might hit the bottom line. I did notice that with the capital gains tax changes, for example, they learnt their lesson from Bill Shorten's time and did put a exemption for age pension, disability pension recipients, JobKeeper recipients on the 30% minimum tax on the capital gains tax rate. So I think those sorts of elements, were learnings, I guess, for that terrible term, but from that time. So yeah, a bit of a taster, see how the electorate reacts, and then as Pat was alluding to, maybe we'll see that in those pre-election announcements or next budget as well, the reaction will be clear. If they feel like they've got more room to make the changes, then we'll see some more aggression. And if these are received poorly with the unintended consequences as we all analyse them, with individual client files, then they might retreat and do little else. But fundamentally, we need structural reform, don't we? And I think a lot of our clients, as we speak to them, they're sort of aware that the bigger picture is a problem. It's not always palatable when it hits your own bottom line, of course.
Of course. And what about yourself, Pat?
Yeah, there was more losers than winners. That's what I felt. Like you're saying, Bill Shorten, he was vindicated. It was his birthday yesterday, so he got to celebrate a little bit.
There you go.
So he got some vindication in the end. Yes, tax reform was needed somewhat. Again, they haven't talked on this intergenerational wealth. Is an inheritance tax going to come up? But yeah, more losers than winners. So I feel like that's the state of play with this budget.
Yeah, okay, fair enough. So look for mine, there's probably a couple of points that I probably want to raise. I think from my perspective, I think it's incredibly brave by the government to want to make these changes. I think these are hard changes. They're not easy. And, one thing we've been very quick to do is be critical of the Albanese government, to say that they do nothing, that they're insipid, and that they're weak. Last night's decision to go out there and go, no, we're doing this, and we're doing it in these dates, and we're not going to an election, we're doing them now. From that perspective, I think is pretty brave. So kudos to them for doing that. The interesting thing that I'm finding is that when challenged before the election on these very points about whether or not these changes would apply, there was a particular quote that Albanese had made where he said, for the 50th time, there won't be any changes to A, B, C. I think that's going to haunt him. And I think that's going to be a commercial which is played over and over and over again from that perspective. Now, in fairness, we live in a time where deceit, lying, and God knows whatever else by public officials and politicians has been normalised. So, I don't know why we're surprised, but ultimately it's just going to be one of those things. Now, it's incumbent on them to prosecute the reasons for it. I think there are genuine reasons as to why you would make these changes. But at the moment, I know for mine, it probably feels more like a cash grab than it does feel like the reform side. So you feel like you've listened to one side of the record, but not the other side. When I listen to the full record, then I'll pass judgment properly, and that might be in the fullness of time. So that's probably the issue. I think the challenge for most people at this particular moment in time, when we think about what the government is trying to do, it's really important to just take breath and go, well, okay, how does this impact me? And the thing that's probably clear in my mind is that with the government changing the goalposts rather significantly, the need for advice and the need for having a calming influence by your side, so you can actually make clear and informed decisions, is probably more important today than what it ever was. Like I've been around in the industry now since 1996, which, God help us, that feels like a very long time. But in that time, I don't remember many significant budgets in truth outside of the 2007 and outside of 2026. These are very significant reforms. So, from our client's perspective, I think it's really important just to go, okay, take it within your stride. Let's see how these things evolve. I don't think it's going to be smooth sailing. We've already heard that the coalition or the Liberal Party will oppose certain reforms. I imagine the crossbenchers will have a bit of fun from that point of view. I imagine the Greens will have a bit of fun from that point of view. So it's not going to be as simple as just going, okay, this is what we want to do and let's just do it. As to whether or not I'm right on that point, I'm not entirely sure. In terms of questions from that point of view, I noticed from our client's perspective, the one of the questions or one of the key considerations, I guess, from that point of view, from a tax perspective, is should we be doing anything now? Anthony, happy for you to respond on that one. My view there would be, no, you wouldn't be doing much at this particular moment in time.
No, that's right, Luke. Most of these changes, the earliest stuff is 1 July 2027. Everyone should be doing their normal pre-year-end planning for 30 June this year in terms of super contribution caps, etc. But yeah, there's no need to rush into this. But those with more than just your general mum and dad client with family trust or a super fund or companies, etc., should be undertaking a review at some point in the future, and just in regards to the appropriateness of what's in place, and is there opportunity for change that will benefit them into the future?
Yeah, absolutely. Here. And I think one thing, it's good that you mentioned super there, because you'll notice here, people, we didn't talk about super today at all. That's because it went unscathed. Super wasn't mentioned in the budget. Outside of the capital gains, where the capital gains rules that currently apply will continue to apply. So there was no actual change there. So I guess the best game in town still continues to be superannuation. The next best game, I guess, is the principal residence. So that's still capital gains tax exempt. I'm not proposing there'll be any changes there. And I think any government that tries that will sign a death warrant on that piece. So you've got those ones. But, you know, as we've seen, we've got a government who's got a bit of courage and happy to change. And I guess that's what happens when you have an opposition that is focused inward and probably on populist policies rather than coming up with the policies that speak to the entire electorate. So that's the consequence of that, I dare say. All right, to all my colleagues, one thing I will say is thank you. I know you've been up very early this morning, reading all the information, trying to keep up to date with all this sort of stuff. We didn't get much sleep last night because obviously we were trying to condense all this information and get it to you as quickly as possible. So thank you for all your work there. To the team here at Innate as well, thank you as well for all your efforts. I believe emails have gone out explaining all these things to clients as well, which has been fantastic. And to our wonderful clients, thank you for joining us in such wonderful numbers too. I'm always bemused that you'd want to spend a bit of time and hear about these sort of things. So we thank you for doing that as always. All right, until we meet again, all the very best. Get out there, enjoy the sunshine, and we'll chat soon. Cheers, guys.